Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
And we are diving straight in today because this particular deep dive is designed entirely for you, the UK retail banking professional. We're framing this briefing around a frankly intense collision of events landing right on your risk committee's desk this week. We are talking about geopolitical shock, rapid regulatory enforcement, and rising consumer finance risk, all hitting at exactly the same time.
Spot on. We are pulling from a really dense stack of materials today just to give you the complete picture. We've got the Office for Budget Responsibility spring forecast, immediate FCA enforcement notices, some quite alarming shipping data straight from the city, and of course comprehensive reports across the financial press.
We're keeping the energy high and the insights sharp today. Think BBC Hard Talk meets the Financial Times. The Treasury is currently doing its absolute best to project a sort of vernal springtime stability. But make no mistake, global maritime realities are sending a severe shiver right through the City of London, and that is going to trickle down to your daily operations.
It absolutely will. So to understand why, we really need to start with the baseline numbers from the Chancellor's Spring Forecast 2026. The overarching narrative, the one Rachel Reeves is presenting anyway, is focused heavily on fiscal discipline. However, the OBR actually downgraded UK 2026 GDP growth from 1.4% down to 1.1%. And the primary driver they cited for that revision was lower net migration.
Right. A drop to 1.1% isn't exactly the roaring growth the market wants to see. But there was some good news for the Exchequer in the numbers, wasn't there?
There was, to be fair. Borrowing is actually down by nearly £18 billion compared to the autumn projections. That creates a rather comfortable fiscal headroom of almost £24 billion against the government's own stability rule.
That's a decent cushion. And looking at the specific policy measures, it reflects a very cautious approach. I mean, the Chancellor completely avoided implementing any new bank levies, which I know will be a massive relief to many of you listening right now.
Huge relief.
She also reaffirmed the freezing of income tax and national insurance thresholds through to 2028. We saw minimum wage uplifts, a £150 cut to household energy bills coming in April, and a new council tax surcharge targeting English homes valued over £2 million.
It sounds incredibly stable on paper, but here is the key tension we have to unpack for your risk models. There's a massive clash between the government's message of stability and the actual market reality out there. The government claims these specific measures mean people will be with £1,000 better off. But critics of the forecast argue impartially that those numbers were essentially out of date the moment they were published. Global energy shocks have fundamentally altered the landscape since the OBR actually crunched that data.
Absolutely. You just have to look at the market reaction on the day. The FTSE 100 dropped 2 to 3% right after the announcement. But that sell-off wasn't driven by the fiscal package itself at all. It was driven entirely by spiking global oil prices.
Exactly. And this is exactly why it matters directly to your retail banking strategy. This tension fundamentally changes the macroeconomic assumptions underpinning your lending models. Markets are currently aggressively scaling back their expectations for near-term Bank of England rate cuts. Renewed inflation risks mean the base rate is likely going to stay higher for much longer than anyone anticipated.
Which is a complete double-edged sword for retail banks, isn't it? On one hand, a higher base rate certainly supports your short-term deposit margins, but on the flip side, it threatens to severely dampen mortgage lending volumes, and more importantly, it compresses borrower debt servicing capacity. If energy bills rise because of global shocks and mortgage rates don't fall as the consumer expected, the squeeze on household disposable income is going to be intense.
Which brings us directly to the actual source of that inflation risk. We need to look past domestic policy now and focus on the geopolitical energy shock unfolding right away. There is essentially a shadow blockade happening in the Strait of Hormuz, following the recent U.S., Israel, and Iran strikes, which you'll see referred to in the briefings as Operation Epic Fury. The London marine insurance market has effectively paralyzed the waterway.
The numbers coming out of Lime Street are staggering. The Lloyds of London Joint War Committee issued 7-day cancellation notices on legacy war risk cover for Gulf shipping. War premiums have surged from just a few basis points, around 0.05%, to between 0.3% and 0.7% of a hull's total value.
Let's contextualize that for a second so you can see the scale. If you have a very large crude carrier, a VLCC, worth $100 million, a 0.7% premium means you're suddenly paying an extra $700,000 just for insurance on a single voyage. It is a calculated repricing of global trade by a dozen lead underwriters in the city, and it makes the transit of 20% of global petroleum effectively uninsurable on those old terms.
And that move from London sparked an immediate, direct sovereign challenge. U.S. President Donald Trump intervened, ordering the U.S. Development Finance Corporation, the DFC, to step in and provide state-backed political risk insurance, alongside naval escorts. Reporting impartially on this, it is an explicit state-backed challenge from Washington, directly targeting the City of London's centuries-old dominance in pricing marine risk.
It's a huge shift in the geopolitical plumbing of finance. But let's bring it back to the macro transmission for UK banks. You have to stress test your portfolios for stagflation immediately. A sustained oil spike of this magnitude threatens a 0.8 percentage point bump in inflation across advanced economies.
Right.
For banking professionals listening, this means you must prepare for a severe squeeze on consumer real income. You need to model for higher non-performing loans across your retail and SME books, and seriously prepare for potential dollar funding stress in wholesale markets.
And while geopolitical shocks are hammering the macro environment on the outside, there's an equally dangerous threat brewing internally for firms right now. The FCA just delivered a brutal lesson in financial culture, and they made a nearly £13 million example out of it.
They certainly did. The FCA fined the engineering firm John Wood Group PLC £12.99 million. And you should note that figure actually includes a 30% settlement discount from an original penalty of £18.5 million.
The FCA explicitly cited a poor financial culture at the firm. Staff reportedly felt immense pressure to toe the party line to meet market expectations, and that toxic environment led to highly inappropriate accounting judgments, specifically on their lump sum turnkey engineering, procurement, and construction projects.
Let's unpack that jargon for a moment, because it's central to how the risk actually materialized. A lump sum turnkey project is essentially a contract where the engineering firm agrees to deliver a fully completed facility for a single fixed price.
Yeah.
If the costs overrun, the firm eats the loss. It is a high-risk model. And when those projects started bleeding money, the internal culture dictated that they hide it.
The specific failings are glaring when you look at the numbers. The firm failed to provide for $8 million in future costs on Project A. They assumed $22.9 million in entirely unrealistic cost savings on Project B, and perhaps most egregiously, they inappropriately released $32.4 million in project-related contingencies just to offset losses elsewhere in the business.
The fallout from those mass losses was catastrophic for investors. Between November 2024 and March 2025, Wood Group suffered a 78% share price collapse, and their shares were ultimately suspended. But what you really must note as a banking professional is the speed of the regulator here. The FCA concluded this incredibly complex investigation in just 9 months.
That isn't a coincidence. That is a deliberate showcase of their new, aggressive speed of enforcement. The warning for your risk committees is crystal clear. Regulatory intolerance for masking financial distress or manipulating accounting judgments to maintain market optics is at an all-time high.
Absolutely.
If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
Moving from corporate culture back to the retail side, we have a triad of massive consumer finance shifts happening right now. First, let's look at the FCA's update on the motor finance compensation scheme. They have finally confirmed a 3-month implementation window, which stretches up to 5 months for older agreements.
The final rules are expected in late March, and interestingly, they've announced they will be published outside market hours to prevent immediate share price volatility. This paves the way for millions of consumers to receive compensation in 2026. The takeaway here is strictly operational. You must ensure your capacity is fully scaled right now to handle this incoming wave of consumer complaints and payouts.
Spot on. And while we are talking about consumers, there is a massive shift happening right at the digital checkout that retail banks need to monitor closely. Open banking payments, often branded as pay by bank, are surging. They are now hitting 30 million successful transactions every single month at major retailers like Amazon and Ryanair.
But there is a massive consumer protection vacuum hiding right behind that convenience. Money-saving expert Martin Lewis has issued a stark public warning about this. When a consumer uses a debit or credit card, they are protected by Section 75 of the Consumer Credit Act or chargeback rules if the retailer goes bust. These pay-by-bank transfers completely lack those protections.
None at all. If a retailer collapses, consumers using pay-by-bank are left as unsecured creditors. They essentially lose their money, which makes this a critical immediate risk area for retail banks. You must ensure your customer communications around open banking payments are exceptionally clear.
Right, because if your customers do not explicitly understand that they are forfeiting purchase protection by clicking pay by bank, you are going to face a tidal wave of ombudsman complaints when a major retailer inevitably goes into administration.
On the other side of the consumer ledger, we are witnessing an unprecedented rush into savings. UK savers are frantically scrambling to stash a record £115 billion into ISAs this tax year. This massive influx is pushing total UK ISA values to a staggering £1 trillion.
And this boom is entirely policy-driven. It stems from the Chancellor's announcement that from April 2027, the £20,000 cash ISA allowance will be aggressively slashed down to £12,000 for anyone under 65. Retail banks need to capture this liquidity right now while simultaneously managing the severe operational strain of this sudden influx.
Alongside this savings boom, the FCA officially opened its Targeted Support Authorization Gateway on March 2nd. This is huge. It allows banks to guide specific consumer segments without crossing that dangerous, heavily regulated line into individualized financial advice. It's a massive commercial opportunity to engage the millions of adults currently holding excess cash, but requires completely airtight compliance frameworks to execute safely.
Let's shift gears and look at the actual plumbing of the UK financial system. The Bank of England has confirmed it now possesses the in-house capability and intellectual property to run the real-time gross settlement system, or RTGS.
For those who might not deal with the back-end infrastructure daily, RTGS is the absolute beating heart of the UK economy and is how banks settle money with each other in real time. By taking this in-house, the Bank of England is officially ending its reliance on external contractor Accenture, and the scale of this bespoke system is almost hard to wrap your head around. It processes £790 billion in transactions every single day.
It is massive. Now, a recent National Audit Office report did highlight that the annual operating costs for the system have risen to £41 million. But Deputy Governor Dave Ramsden rigorously defended the move to MPs, and his reasoning points to a much broader regulatory trend.
Right, because spending £41 million a year sounds steep, but retaining the software in-house completely prevents massive, unpredictable downstream bills. More importantly, it avoids highly dangerous vendor lock-in. This aligns perfectly with the broader regulatory pushes we are seeing across the entire financial sector regarding operational resilience in critical national infrastructure. Third-party vendor risk is a top priority for regulators right now, and the Bank of England is essentially leading by example.
Finally, let's look at some quick-fire corporate updates from the fintech sector, starting with a major win. Challenger SME lender Alika Bank has officially hit unicorn status. They reached a $1.2 billion valuation following a highly successful $155 million Series D funding round, which they're going to use to fuel their European expansion.
It's a rare bright spot for UK fintech right now. We also saw Vivox AI raise £1.3 million. And what's interesting there is that they're backed by former UBS chairman Axel Weber. They're building what they call regulator-ready AI agents. The efficiency gains they are claiming are frankly stunning. They say these agents reduce complex anti-money laundering processing from 6 hours down to just 30 minutes, while simultaneously cutting false positives by 85%.
The Vivox CEO, Tim Comzen, made a really fascinating point about the workforce impact here. He stated that the traditional compliance analyst is rapidly evolving into a compliance engineer. The role is fundamentally shifting from manual data gathering and spreadsheet checking to actually supervising and training these AI agents.
That is a massive operational shift for AML teams. But we must conclude this section with a brutal cautionary tale from the retail investment space. BrewDog, the former craft beer darling, was just acquired by the U.S. cannabis group Tilray Brands for a mere £40 million via pre-pack administration.
Let's quickly explain that term for context. A pre-pack administration is an insolvency procedure where the company enters administration and its business or assets are sold immediately under a deal arranged before the administrator was even appointed. It's designed to save the underlying business, but it is notoriously brutal for existing shareholders.
Brutal is the right word. A rescue bid by BrewDog co-founder James Watt was completely rejected. And the reality here for retail crowdfunding is incredibly grim. 220,000 retail investors, who BrewDog affectionately called equity punks, were wiped out completely. They lost the £75 million they collectively invested over the years. It is a stark, painful reminder of the massive risks inherent in unregulated retail investment schemes.
Let's rapidly recap the 6 core topics we have covered in this deep dive, because there is a lot for your risk committees to digest. We started with the spring forecast's attention with global energy shocks. We covered the Hormuz insurance standoff fundamentally challenging London's maritime dominance. We analyzed the FCA's incredibly speedy £13 million fine against Wood Group for cultural rot and mass losses.
We then broke down the consumer finance triad, the incoming motor finance compensation wave, the hidden consumer risks of pay-by-bank, and the trillion-pound ISE rush ahead of the allowance cuts.
Yeah.
We looked at the Bank of England asserting RTGS independence to mitigate third-party risk. And finally, the wildly mixed fortunes of UK fintech, from Alka Bank's unicorn valuation to Brewdog's complete collapse.
So here is the actionable intelligence for your compliance and risk teams today. First, you must stress test your retail and commercial portfolios for stagflation immediately. The Hormuz crisis is not just a shipping issue, it is a direct inflation issue. Second, you need to review your internal financial reporting culture right now in light of that Wood Group fine. Ensure there is absolutely no implicit pressure to toe the party line on accounting judgments within your firm.
Third, you must prepare serious operational and staffing capacity for the incoming wave of motor finance complaints hitting in late March. And finally, you must audit and ensure all your customer communications regarding pay-by-bank are totally watertight to avoid mis-selling accusations and ombudsman action when the next major retailer collapses.
I want to leave you with a final, broader concept to mull over as you head into your week. Look at the events of this briefing collectively. We have the U.S. government actively stepping in to underwrite marine risk in the Gulf because the private market won't. We have algorithmic AI agents taking over complex AML investigations from human analysts. This signals a profound paradigm shift.
The very plumbing of global finance is no longer being dictated purely by free market bankers sitting in the City of London. It is increasingly being rewritten by sovereign statecraft on one side and algorithmic engineering on the other. So ask yourself this: are your firm's risk models truly ready for a world where the state and the machine are the ones pricing the risk?
That's all from us this week. Thanks for listening to RegTalkUK.
Until next time, stay sharp and stay compliant.